This review is for depreciation recapture provisions on page 7-21 of your text. Recall that business assets are considered Code Section 1231 property. So these assets are broken down into land, which is not depreciable, so it is a pure Section 1231 asset, or it's personal property like equipment, furniture, and computers. That's Section 1245 property, and these items are depreciated. Then you have real estate and other like rental property and other real property that fall under Section 1250, and these items are depreciated also. So when we sell Section 1245 and Section 1250 assets, we have to remember the depreciation recapture provisions. When we sell assets, some of the gains get preferential tax treatment or lower tax rates. So gains on depreciated property like Section 1245 and Section 1250 assets occur because every time an asset is depreciated, its basis gets lower and lower. So if there's a gain on Section 1245 or Section 1250 assets, some of it may have been due to the depreciation lowering the basis of the asset. So since businesses have already benefited from taking depreciation on assets as an expense year after year, the IRS does not want businesses to get another tax benefit by getting preferential tax treatment on gains due to depreciation. Therefore, we have to look at Section 1245 and Section 1250 gains very carefully. So let's look at the Section 1245 gains first. So Section 1245 assets are personal trade or business property subject to depreciation, like we have up here, equipment, furniture, and fixtures. So any gain on the sale of Section 1245 assets in excess of depreciation gets preferential tax treatments or capital gain rates, and we know that those are lower than our ordinary tax rates that we typically pay. Then the gain on the amount of depreciation is taxed at regular or ordinary rates, and this is called our depreciation recapture, and it gets no special tax treatment. So let's take a look at our example here. You'll find that on page 7-17 of your text. So it says on May 1st, 2013, Jason purchased equipment costing $12,000 for his business. Depreciation deducted on the equipment in previous years was $73.92. So the adjusted basis of his equipment is $46.08. So the equipment cost $12,000, but we've taken depreciation, so the basis has been lowered all the way down to $46.08. So now we're going to look at some independent situations where there was a sale of this equipment. Okay, so in situation 1, Jason sold the equipment for $13,000. His basis, as indicated in the problem, is $46.08. So that gives us a big gain of $8,392. However, some of this gain is attributed to the amount of depreciation, and the company has already benefited from taking this depreciation in the past. So we only get preferential tax treatment on the amount of the gain that is in excess of the depreciation. So the gain was $83.92. The depreciation recaptured, as given in the problem up here, was $73.92. So the difference is $1,000. So the $1,000 gets capital gains treatment, or a much lower tax rate, whereas the $73.92 portion of the gain is taxed at ordinary rates. Okay, so now let's look at situation 2 where Jason sold the property for $9,000. Okay, once again we have a basis of $4,608, so his gain is $4,392. His gain is lower than what his depreciation was, so none of the gain is in excess of the depreciation taken in the past. So 0 is the amount that gets preferential tax treatment. So the entire $4,392 of the gain is taxed at ordinary tax rates. Okay, so in situation 3, we have a loss, so we don't have to worry about the gain or recapture, so we just get an ordinary loss on our books. Next, we'll look at Section 1250 property. Recall that Section 1250 assets are depreciable real property used in a trade or business, such as an office building or residential real estate. And the gains are treated very similarly to the way the Section 1245 gains were treated. So the amount of capital gain attributable to depreciation previously taken is taxed at the 25% rate up to the depreciation amount considered unrecaptured. So this is like the depreciation portion of the gain for the Section 1245 property, except we don't tax it at ordinary rates, we tax it at the 25% rate. So any remaining gain in excess of the depreciation gets preferential tax rates. So let's look at the example that we're given down here. So here we're going to calculate the gain and then also calculate the tax that is applied to the gain. So Joe used a building in his trade or business that he purchased in June of 2011 for $165,000. He sold the building in June of 2015. Assumed straight-line depreciation was taken in the amount of $16,927. So the adjusted basis of the building is $148,073. We started at $165, and we have to reduce the basis by the depreciation that was taken. So that lowers the basis to $148,073. So we're going to look at these independent situations, and we're assuming that the capital gains rate, the preferential tax rates, will be 15%. So Joe sold in situation 1 the building for $172,000. We were told that the basis is $148,73. So we have a gain of $23,927. Okay, so the depreciation was $16,927. So the amount up to the depreciation of the gain is $16,927. That's going to be taxed at 25%. It doesn't get any preferential tax treatment. The amount in excess of the depreciation, so if we took $23,927, the total gain, and subtracted $16,927, the amount of the depreciation, then we get the amount of the gain that gets the preferential tax treatment. So $7,000 is going to be taxed at a lower rate of 15%. Now in situation 2, the building was sold for $160,000. The adjusted basis is still $148,073, so that gives us a gain on the sale of $11,927. Notice that the $11,927 gain is not in excess of the depreciation, so no amount of the gain is in excess of the depreciation, so we get no preferential tax treatment or no Section 1231 gain. The entire gain of $11,927 is taxed at the 25% rate. Then in situation 3, we sold the asset for $140,000 and had an $8,073 loss. Therefore, there is no gain, and we just treat the loss as ordinary.